Welcome to our YouTube Live, and this is my take on the FOMC meeting. And the purpose of this is just to do a fairly concise summary of what Jerome Powell said, but also to talk through the implications and some of the data also that's around the latest decision. So just starting with the basics, yes, they kept rates on hold. Markets were expecting that, and that's exactly what they did. It's quite unusual for the Fed for this rate hike cycle to really go against what markets expected, and this was no exception. If I had to summarize what Powell was saying this time around, he reiterated, as he has done before, the fact that they've come a long way. That means they can have more time now to kind of see where they're getting in terms of whether this policy is restrictive enough. And there are signs that it's restrictive enough, but as many of the journalists pointed out later in the press conference, things are still pretty much going at full pelt in the US economy. US consumers are going out and spending, wage growth is positive in real terms, and people are getting higher wages in real terms, spending those wages, that's increasing demand for goods and services. So really the US economy is pretty strong, but it does seem as if the supply and demand dynamic for the US labour market is coming back into balance. And we'll see data for that in a moment. Also, the risks now are more balanced, because just 18 months ago, the concern was that the Fed wasn't doing enough and that inflation would stay high for a long period of time. Beliefs about high inflation would get entrenched. And then, of course, once people anchor on a high rate of inflation, it becomes self-fulfilling. The risks now people see are more balanced towards crushing economic growth and stopping the recovery. So the risks are now more balanced, so clearly they are closer to the end of the cycle. But Powell made it very clear that by no means is this necessarily the end of the rate hikes. There could be more to come. And at the moment they're very much in the mode where they're looking to see whether the current stance of monetary policy, with rates of between 5.25% and 5.5%, very high, is sufficiently restrictive to get inflation sustainably back down to their 2% target. So at the moment they're still saying, is this tight enough? The next question is going to be, how long should we keep it this tight? But we're not quite there yet. And there's no discussion of cutting interest rates yet. So that's still a long way off. So that's a kind of summary of where we find ourselves. And there was a brilliant question from Nick Timraus of the Wall Street Journal, who said, what makes you confident that tighter financial conditions will slow above trend growth, which is what the US has got right now, when 500 basis points of rate hikes, quantitative tightening, and a minor banking crisis have not thus far? So we've had all these things which should have slowed down the economy, but it just seems like the US economy is unbreakable at the moment. So Powell said, well, it operates with a lag, monetary policy, and there are signs that it's slowing down stuff. You know, if you look at surveys of household spending, people are less likely to buy durable goods. They say that high rates have made it less attractive. The housing market's slowing down. But yeah, the economy is really strong. And then he said, we take the economy as it comes. It has been resilient. We take it as it is. So, yeah, great question from Nick Timraus. Of course, the definition of madness is you keep on doing the same thing and expect a different outcome. Anyway, let's get on to the actual data itself, because I think it is kind of interesting looking at expectations and how those have changed over time. And I will share this with you in just a moment. Here we go. And yeah, so expectations first of all. So every now and then I kind of take a snapshot of what the expected monetary policy is on the morning of the meeting. So this morning I took it again. So this is where we were in February of this year, and the first rate cut was expected to be today. That's what they thought. They thought this would just be a bit of a hiking cycle. They'd stop at between 475 and 500 basis points, and then today there'd be the first rate cut. Well, That didn't happen. And then expectations got brought forward. They thought the first rate cut would be in July of this year. Of course, that didn't happen either. And then gradually markets have come round, meeting to meeting, for a later and later first rate cut. So, in June it was expected to be December. In July it was expected to be March of next year. And then in September it was expected to be June of next year. And today it was expected, this morning it was expected that the first cut would be in July of next year. So the Fed's messaging is finally hitting home, which is that no, we're not even talking about cutting interest rates yet. So markets have finally come around to that point of view. And perhaps that's why stock markets have been pretty weak recently in the US. The crazy NASDAQ rally that we've seen has sort of fizzled out a bit. We have seen a bit of a sell-off. We saw a big rally after these comments from the Fed today, but a one-day move is usually fairly, it doesn't really mean much. But we have seen a weakening of the stock market, and that was one of the things that Powell cited as a sign that monetary policy was working. If you look at the actual language of the statement, this shows you the changes since the previous monetary policy statement. Because of course before the meeting they published this kind of terse few paragraphs of what they've done, and really the language has changed, I think, to show how strong the economy's been. So instead of saying has been expanding at a solid pace, instead they say expanded at a strong pace. There's just no question the US economy's very strong. It's got above trend growth right now, if you look at GDP growth. Job gains are moderating, so clearly that's good news. Supply and demand for jobs is getting back into balance. That's one of their goals. But the employment market remains strong with low unemployment and elevated inflation. So that bit didn't change. And other than that, there were no changes to the overall statement. Policy was kept at between 5.25% and 5.5%. So no change in the policy rate. They continued to do quantitative tightening, and we'll see the numbers for that too in a second. So no huge changes, just a stronger economy, I think, compared to last meeting. And again, you can see I've got a bit of an issue with Nick Timraos. I'm quoting him quite a bit. What he's saying here is that Powell is trying to get away from what they were saying in the dot plots. Now remember the summary of economic projections. There's one dot for every member of the FOMC committee. They say what they think is going to happen to growth, to inflation, to their policy rate in the periods ahead. And they didn't publish one this time. They will publish one in December. But all the Powell would say would be that, yeah, we'll submit another set in December. But he was trying to shy away from potentially talking about another rate hike, which was the median of the SEP submission in September. So maybe he was kind of hinting that there's not going to be another rate hike. I don't know. But Nick Timraos certainly seems to think that Powell was distancing himself from the dot plot, which predicted there would be another rate hike to come, and that would be in December. So maybe he's just trying to avoid cornering the Fed into having to do that, or disappointing markets if they don't do that. But interesting. And a really important point here is the colour of Jay Powell's tie, which I think is highly significant. And to the person who responded to my tweet earlier, I was being sarcastic. But look, here's the evidence. So this was the previous meeting but one, and that was kind of hawkish. And then previous meeting, it was a hawkish pause, they called it. Now this meeting, notice the change in colour. I'd say that's Barney the dinosaur colour. But see, it's gone grey, and I think that could be dovish. So I called the end of the rate hike cycle on the basis of that colour change. I could be wrong. So now let's look at that summary of economic projections that I was talking about. Of course, this didn't change, but just to remind ourselves, this is published not at every meeting, but I think it's every other meeting. And if we were to summarise it, this is the projected dots. Now you can see that by December, the median dots were projecting a rate of 5.6%. So instead of between 5.25 and 5.5, this is looking like there might be another rate hike by the end of this year, which would be a December rate hike because we've only got one more meeting. So that's what Powell was distancing himself from. But certainly in September, what the expectation would be that inflation would be kind of beaten at some time by the end of 2024, and rate cuts would have begun by that point. And then by 2025, we'll be deep into rate cut territory. And of course, the longer run would be that rates would be coming back to a normal level of around 2.5 to 3%. That would be the kind of non-restrictive rate. So certainly where the Fed is now, between 5.25 and 5.5, is what they consider to be pretty restrictive, but maybe not restrictive enough. So let's just move on. The labour market tightness is what it's really all about. So is it difficult for people to find a job, or is it easy for them to find a job? And it's pretty clear at the moment for the US that if you look at the number of job vacancies per unemployed person, it's well below the peak that we had previously, which was 2 vacancies per unemployed person. And just looking at data going back to 2000, you can see how incredibly tight that labour market was, with loads of jobs available relative to unemployed people. So at the moment, it's still looking pretty tight. So, and that's obviously inflationary. So it has come down, but it seems to have slowed down the rate of fall. So that's not good news from the Fed's point of view. They would like to see that number falling faster, just to show that demand for jobs is no longer hugely outstripping supply of workers, because that's inflationary. So what they're trying to do, of course, is slow down economic activity, reduce demand. That reduces demand for labour, and that reduces inflation in wages. And of course, if we zoom in on that, you can see that historically, the grey bars show you recessions, and the very effective way of reducing the tightness of the labour market, to loosen the labour market, is to have a recession. So recessions very convincingly drop that tightness of the labour market, because by definition, if economic activity is weaker, there's less demand for stuff, for goods and services, and less demand for labour, more unemployment, and that pushes down inflation as well. So far we haven't had a recession. There was a micro recession here during the pandemic, but it really didn't last long, and we haven't had one recently. So you can see why the labour market remains tight as the US economy remains strong. If we look at non-farm payrolls, this is the number of jobs which the US is adding to its economy month by month. The top graph shows you the level of US non-farm employment. So that's roughly 160 million jobs, hard to judge by the graph itself. And then if you look at the monthly changes, which is what we usually look at, you can see that that's been bobbing along at about 250, 260,000 over the last 4 or 5 readings. Now, just to absorb new entrants into the market from people leaving college, people leaving school, the dashed yellow line, I've kind of zoomed in on the monthly changes here, you'd need about 100,000 payrolls number, new jobs per month, to absorb those new entrants and not to decrease unemployment. And yet, we're still well above that. So it's not as hot as it was previously in 2022, but it's still not cool, and it's still well above the 100,000 neutral absorption rate for new jobs. So still very big demand for US workers. And one of the things that Powell said was that it's not that the demand has dropped that's bringing this back into line, demand and supply of workers. It's that there's been a big supply of new workers, either through immigration or because people who are retired are coming back into the workforce, or people who are outside the workforce have come back into the workforce. So still big demand, but bigger supply of workers. So it does look as if there's something that's a little bit like a price wage spiral, but that has abated recently. Now this is every central banker's worst nightmare, is that you get an increase in prices and then people demand wage increases to pay for stuff, and that way the two keep chasing each other higher. Higher inflation, higher wages, higher inflation, higher wages. Well, that seemed possible for a while. However, currently what's pretty clear is that headline CPI inflation, the main number, which includes things like energy, that has come down a lot. So that's at 3.7, that was the latest print. And earnings growth was around 4.2, so that's come down a lot in the US. It peaked at well over 5%, but it's still way above where it was, if you can remember, in the normal world pre-pandemic. Their wage growth was around 2.5 to 3% per year. So 4.2 is still running hot in terms of wage growth, and it's real wage growth, which is good for the average US citizen, but it's bad news in terms of cooling inflation. So hopefully that'll carry on falling. It'll still be positive. It may still be real if inflation carries on falling, but this price wage spiral has not come to pass, which is you could almost hear the sigh of relief from the Fed that that hasn't happened. So now the other thing which of course the Fed's got in its toolkit is the balance sheet. It bought $9 trillion worth of treasuries and mortgage-backed securities, and it's unwinding that very carefully. I recently made a video about the Bank of England, which is making the mistake, I think, of selling its bonds. It's not just letting them run off the balance sheet. It's not just letting them mature. It's actually selling its bonds and pushing up yields as a result. And not just the short duration bonds, but the really crazily long duration bonds, like the 2073, the 50-year bond, which is down 60%, 65% over the last couple of years. It's selling that at a loss and having to be bailed out by the UK Treasury. The Fed, on the other hand, is just letting them run off its balance sheet, not selling anything. And that's fast enough for the Fed. Now, it's interesting if you look at the yields at the moment, and I will be doing a live stream tomorrow about the Bank of England, and I'll probably mention this again then. I'll also be doing a webinar with Cbonds, which is kind of like an incredible data source for bond data. So I'll be doing a kind of webinar for them. There'll be a link in the description below if you want to register for it. It's free. And I'll be talking about whether money market funds are better, or let me just talk to camera here because it's probably easier. Whether money market funds are better, or whether it's better to buy government bonds. And really it's a question about what's going to happen to policy rates and what's going to happen further out on the curve. In other words, will the short end come down and reduce income on money markets and make them less attractive? Or will it be better to lock in a rate at the longer end of the curve now that yields are higher? And it's not a clear-cut question, but that's the one I'm going to try and address during that webinar. But if you do want to register for that with Cbonds, you'll find a link in the description below. So back to the scheduled program. So here's the balance sheet of the Fed, and you can see that it's down, way down from its $9 trillion. There was a bit of a hiccup, and that was the banking crisis when the Fed made its balance sheet available to banks, and that bloated the balance sheet again. But of course that ended, and now it's rapidly falling again at a pace of about $95 billion a month. So overall that's over $1 trillion a year. So very rapid shrinkage. And if we compare it to even more history, if we go back to 2004, you can see that it's fallen by about 12% from its peak, which is pretty chunky. So quantitative tightening is ongoing, that carries on, and although they have paused their policy rate increases, quantitative tightening, you could argue, is still tightening conditions, credit conditions, and economic activity should be slowed down by quantitative tightening as well. So that's another tool in their armory of unconventional monetary policy. So progress in core inflation. Previously this title was little progress in core inflation, but now I think there kind of is. Let's not be too downbeat about this. If you look at CPI core inflation. This is if you strip out energy and food, which are very volatile. Core inflation, remember, is a better predictor of future inflation, so that's why the Fed focuses on it. And you can see core is falling pretty fast. That's the yellow line. Headline, of course, is driven lower by energy prices falling. Energy, of course, has now ticked upwards again, so there's a little tick up in headline inflation, but core continues to fall. So that was 4.1% in the latest print. And if you break it down into monthly changes and annual changes, there are quite a few annual components of US inflation which are now in negative territory, in other words, deflation, with utility piped gas service prices falling by about 20% year on year. And if we look at the monthly changes, again, you can see there are several components which are now in deflation, certainly over the last month from August to September. So clearly things are going in the right direction, but the Fed's still not convinced that inflation is down close enough to its 2% target to even think that monetary policy is restrictive enough. If we look at core PCE inflation, so PCE inflation, personal consumption expenditures inflation is what the Fed actually looks at. This is their mandate. It's PCE inflation. Core PCE inflation is also falling. So that's pretty reassuring for the Fed. What Powell did say is that previously we got signs that it was falling and then it ticked upwards again. So, they're still not convinced that this is falling materially down to their 2% target. And of course, it's still almost twice their target. So going in the right direction, but still far from where they want it to be. If we break it down by components, so service inflation, durable goods inflation, and non-durable goods, the bottom two components are very much affected by demand for stuff after the pandemic, which surged, disrupted supplies due to disruptions due to the pandemic, and those have pretty much worked their way through the system long ago now. So inflation in those two components, durable and non-durable goods, the distinction people usually make is that durable is like your automobile, non-durable is the gasoline that you put into your automobile, but inflation for both of those has fallen substantially. It's service inflation which is still high and stubborn, and there's still no sign that that's really abated. So that's what the Fed is trying now to do, to get demand and supply in the labour market back into sync, and then eventually wage inflation should fall, and that's what's primarily driving service inflation. That's the goal anyway. Now the Fed is very concerned about how it's perceived in the markets and by normal people, households. So one of the things they look at is a market-derived measure of where inflation is expected to go. So this is the 5-year forward expectation of 5-year inflation. So what do markets think inflation will be over in 5 years' time for the following 5 years? And you can see that it's still quite a long way above the 2% target, but it is reasonably well anchored. It's not at like 4 or 5%. So the market clearly believes that the Fed will get inflation under control by the time we reach 5 years from now. But what's worrying is that those expectations have gradually been increasing. So the Fed's still credible, but this anchor, the anchor for where markets think that inflation's going, is unfortunately dragging higher. And the Fed's probably not too happy about that. But still, pretty credible, I'd say. So what's the evidence that conditions are now tighter? Financial conditions are tighter. I'll just finish with this one. And I show this every time. This is the Fed's, one of the Fed's own models of financial conditions. It's Financial Conditions Index, which measures 3 different components of financial conditions. And roughly you can think of this as how easy is it to get a loan. But of course it factors into lots of different variables. Credit spreads, for example, the Senior Loan Officers Survey kind of thing. And you can see that when it's blue, that means that credit conditions are easing. Red means they're tightening. So there was a big tightening in 2020 with the pandemic sell-off. But notice how recently it's been easing, right? So that's not tighter credit conditions. That's loosening credit conditions. So all three of these components, in fact, have been moving the wrong direction. So I don't think it's very clear that financial conditions are tightening. Certain rate sensitive parts of the market, like housing, yeah, durable goods, yeah, but people are still out there spending in the shopping malls. They're still buying cars. They're still buying stuff, and that's going to push up demand. It's going to push up prices, and inflation, unsurprisingly, is still well above the target. So that's it. I've got through it, and you got through it if you're still here. Thank you for that. So I will take some questions now. Usually at this point, I summon my dog for a treat. So Laura doesn't realise I've actually stopped talking because she watches it with a lag downstairs. But usually if I summon Teddy, now I've got some special treats here. This is buffalo, a bit of an American theme. Let's see if we can summon the hand. Oh yeah, here we go. Summon the hand. While you come up with questions. Oh, I'm glad you can't smell that. Oh. Oh, here he comes. Here we go. Oh, you like the smell of that though, don't you, Ted? Here we go. Oh, yes. Yes. You liked those. Goodness knows why. Oh, another one. I wish I could show you a trick. He does some really good tricks. You want that? Good boy. Oh, you're clever. Well done, Ted. It's all about Teddy. Right. I'm not going to run you over, it's okay. Yeah, so anyway, let's see if you've got any questions. Somebody said, where's Bubby? Well, he's called Teddy. You always call him Bubby. Why is that, Splooger? So there's Teddy, and you can have one more. So not one of the buffalo ones, one of the low-fat ones. Oh, you've been summoned by Laura. Yeah, go on. Go on. Oh, he thinks he's got one more treat. Come on then, you can have one more. Low-fat. He doesn't want the low-fat. Oh, Teddy. He's so fussy. He doesn't want low-fat treats. Of course not. Okay. Yeah, so anyway, if you have a question, please do ask. Yeah, so I'll be doing this tomorrow night as well. So I'll be doing it for the Bank of England at 6 p.m. And they will be publishing a monetary policy report as well. So there'll be a bit more meat to this one. I'm just hoping that Simon Conway is going to tweet a forecast of where the OIS curve predicts that the Monetary Policy Committee is going to set rates to. So Simon Conway, please do tweet that graph from Bloomberg. I depend on it. I just read his book. It's very good about material world. I've been boring Laura with facts about silicon and sand. It's quite interesting. More interesting than you'd think. Right. So anyway, yes, if you do have a question and you're one of our supporters on YouTube, we'll push you to the front of the queue. And if you do a super chat as well, we'll push you to the front of the queue for the questions. And I'll have a look at the document which Laura gives me. Yeah, the title of the seminar I'm doing with Cbonds is Money Market Funds or Government Bonds, which is best? So that's the topic. And I see we don't have any questions from members or super chats yet. So I'll work my way back through the list. Like and share, yeah. Do like and share. And what have we got? Good evening. Hello, everyone. Hello, Alex M. Hello, Mark Coyle. Hello, Sport Billy. Why does the Fed have a range for its rate, i.e. 5.25% to 5.5%, when the Bank of England has a single figure? Well, funnily enough, we talked about this in the podcast. I think it's just the way. I think it's just the way they communicate this stuff. there are certain ways in which the Fed controls the rate of controls interest rates. But essentially, the idea is that if they've got the risk-free rate of lending, then any other rate has to be higher. So that works in the Bank of England. In the Bank of England's case, it works in the Fed's case. Any central bank will be the same. So that sets the floor. For the Fed, they've also got the ability, I guess, to... well, actually, I never actually understood that kind of cap thing. I don't think there is a proper cap set by the Fed. But they do specify a range. That's where they intend to keep it. But yeah, I don't know how they do the cap. I did read about it, and I did think that's not a very convincing argument. But anyway, if you listen to the podcast, I think it was the last podcast but one, we did talk about it. Let's see if I can find the episode where we talked about it. So our podcast is called Many Happy Returns. And yes, this is shared with me. Range. I look for the word range. There we go. Yeah, I don't know if this one's actually been released yet. Yeah. So I think it's going to be an episode about the most important number in financial markets. So we'll talk about various macroeconomic numbers, and we'll talk about which one we think is the most important one for investors to look at. But there is a thought that there's a discount rate, which is it puts people off lending because of the discount window having some kind of embarrassing factor. If a bank has to go to the discount window in order to borrow, it shows it's distressed. And so the discount rate sets an upper limit for the lending, but I'm not really convinced by that argument. But the floor is set by the interest on excess reserves. So that's the way. There's a kind of floor and a not very convincing cap from the discount rate. But anyway, that's the idea. But the Bank of England doesn't have a cap. It just sets a rate for a minimum rate of lending, which I think is all you need to enforce monetary policy. Having an upper limit is kind of irrelevant, I think. So that's that. So back to your questions. Let's see if there's one from... Yeah, here we go. Super chat from Pep. Thank you very much. Pep says, knowing 65% of my investment will be going to the US stock market with current lofty valuations worries me. Okay. A lot of people say that. But, 65% of the market, global market, is US because it's just good at making higher profits. It's been very successful. And there's no reason to think that immediately it's going to stop being successful. So I'm not that concerned. Eventually I think it is a little bit out of kilter and the US market will shrink relative to the rest of the world. But that doesn't have to be through a US catastrophe. It can just be the rest of the world catching up. Anyway, Pep says, my horizon is only 10 to 15 years and a lost decade could be a real possibility. It's always a possibility. Have a lump sum to invest and would like to put it in an all-world ETF. See good value in some smaller stocks in EU, UK and US, but obviously stock picking also brings additional risk. What would you advise that I do? I don't advise. So over a 10 to 15 year period, will stocks, broad stocks, global stocks, outperform almost every other type of investment? And here I'm thinking about other asset types like property, gold, government bonds. And the answer is almost always yes by asset type. So stocks very convincingly beat inflation long term. If inflation is very high, then stocks tumble. But it seems as if inflation is now coming down. A lot of those temporary effects from pandemic disruptions to supply and demand have pretty much gone now. It's just the wage growth and services inflation which is left in a very sticky state, which higher interest rates is likely to combat eventually. It just takes a while. because monetary policy acts with a lag. So once that comes down, I'd expect that there'd be pretty strong upside for stocks from here. Also, if you look at the US market, so let's have a look at that because that's kind of interesting. Somebody was chatting about this on our Slack channel today, talking about, because we talk about markets, obviously, and we talk about valuations. And one of the trackers which I've got, which members get access to, let me just show you, looks at valuations. And of course, I'm going to show this to you live, so let's hope it's working. My colleague actually keeps this up to date. Let me share. Let's maximize that. So this just answers the question, is the US market cheap or expensive? So this looks at the forward price to earnings multiple. There's also Shiller Cape and excess Cape yield, but let's look at the forward price to earnings multiple. And you can see that at the moment, the forward price to earnings multiple is below the 10-year average and below the 5-year average. It's still not at the 60-year average, which would be a fair price, which would be a fair level over the very long term. But based on recent euphoria over the last decade, currently markets are looking reasonably priced. It's no longer egregiously high as it was in the past. That's because of a combination of things. Firstly, stock prices have fallen. Of course they have since their peak. But also, earnings growth has been pretty good, not catastrophic. There were quarterly falls. There were year-on-year falls for a while. But it looks as if that's kind of slowing down and reversing. So, the US isn't looking as expensive as it did. That's what worried me more, was the fact that the US was a huge proportion of global markets and it was hugely more expensive than those markets. Well, now it's looking just a bit expensive and not particularly expensive. Depends on which measure you look at. Cape still looks expensive. Excess Cape yield, which is the axes are inverted here, that's looking quite expensive, not very. So expensive is below the dashed red line, and it's getting more expensive, but still not incredibly expensive. It's been cheaper about 80% of the time. So is it super expensive? Is it at an all-time high? No. So I'm not so worried about it as you, I don't think. So I think it's not something I'd panic about. But advice on what to do. Well, if you've got 15 years to go until retirement, then it's very likely that over that kind of period of time, then you'd get a positive return on equity. There have been 15-year periods when in real terms it was a little bit touch and go. I think it was 12.7 years was the longest drawdown for the US. So there's never been a 15-year period without positive return. It could happen. I just think it's unlikely. And I think if you compare it with other asset classes, stocks are likely to be the best place to be. And if you tilt towards small caps, as you suggest, in Europe or the UK, that actually increases the risk. It may not increase the return. And remember that if US stocks do fall, then UK small caps, EU small caps would fall more because they're perceived as being more risky. And if people are pulling their money out of US capital markets, then you can be sure they'll be pulling out more money from the EU and the UK. So I think, probably that's a reasonable allocation to global equity. I wouldn't tilt towards small caps and I wouldn't tilt towards another region necessarily. That's going to increase your risk but may not increase your return. You probably don't need to, is what I'm saying. But is that advice? No. But those are the things which I'd consider. I hope that's helpful, Pep. Oh, McCready747, hello. Who does a super chat just to say thank you. No question. Cheers. Thank you, McCready747. He says, good evening. Money for Bloomberg Terminal Fund. That's very thoughtful. I really do miss my Bloomberg Terminal. But I think it's about £10,000 a month. That's how much it costs. So that certainly will go towards it. Thank you, McCready. There's a super chat as well from Douglas Taylor. Thank you, Douglas. He says, what do you think of life strategy 60-40 for a 65-year-old already in retirement with an existing decent occupational pension? Well, of course, not advice, but if you're saying that your occupational pension is paying the way, in other words, it's covering your basics, maybe a bit more than the basics, then any money which you've invested in a SIP or an ISA, that's going to just be additional spending money. So if you've got a defined benefit pension, even better, you're going to get that whatever happens to markets. And that means you can take more risk with the rest of your portfolio. So 60-40, remember, is not particularly risky. 60% equity, I'd say, is not particularly high. So if you've got the capacity for risk, which it sounds like you do, I'm not sure whether that's true. Capacity for risk just means that if markets fall in your life strategy 60-40 portfolio, it's not going to affect your quality of life. You don't immediately need that money. Well, in that case, you can take more risk with the money that you don't need, where the investment horizon is much, much longer, potentially. It could be money that you hand on to your kids when you pass away, in which case the horizon for that is very long indeed. So really, I think that it's not necessarily going to be a bad idea to have a higher equity allocation, but really depends also on your risk appetite, because some people are just not comfortable putting some of their life savings, even if it's money they don't need, putting it at risk. So if you're uncomfortable with the potential for loss, if it's going to make you sleep badly at night, then even though you've got the capacity for risk, you may not have the appetite for risk, in which case 60-40 would be kind of okay. So I think, is that necessarily going to be a bad allocation? Well, probably not. 60-40 is okay. But if anything, I'd say take more risk, but that's not advice. Okay. Very big and very generous super chat from Richard Whiteside. Thank you very much. £100. Gosh, I think that's the most I've ever had for a super chat. And this is about PIBs. So let's have a look at PIBs. So let's have a look at PIBs on Hargreaves' website. So firstly, what are PIBs? So as you can see here, PIBs are permanent interest-bearing shares. They're subordinated debt and they rank lower than deposits and or senior bonds in the event of the issuer being forced into liquidation. So think of it, so the way to think of this is you've got your capital structure. What does that mean? Well, on the liability side of the balance sheet, that's how you funded your company. You've got various degrees of risk. You've got equity, where if a company goes into receivership and then it gets liquidated, then you'll lose 100%. It's almost certain that you'll lose everything if you're an equity holder, unless you manage to sell it beforehand. So they get completely wiped out, the equity holders, because they're at the bottom of the capital structure. Then usually you've got the next level up, like preferred shares and some other kind of hybrid instruments. Then at the top of the capital structure, if it's a bank, say, you've got depositors who've deposited their cash with you, and the government's very keen on protecting them. So they'll probably make good on their entire deposit, if not, a loss of it. So those are depositors for banks. And then if it's not a bank, you've got your secured bonds. Those hardly ever take any kind of hit because they've got a pool of assets set aside. So if a company goes bust, those assets can be sold and make whole the secured bond holders. Then you've got your senior and junior unsecured bonds. Those are low down the capital structure and they won't necessarily get all of their capital back if the company's liquidated. But you can see how this kind of tiering of the risk works. The higher up you are in the capital structure, the people get lower down, get wiped out, and when you've liquidated your assets, you pay off the people at the top of the structure first, then the people below that, then the people below that. And by the time you get to equity, nobody's got any money left. So PIBs sit in the kind of grey zone between equity, so that would be wiped out, and so lower than deposits. So deposits are super high up, remember. Lower than senior bonds. So they're kind of like junior bonds. Okay. So not at the top of the capital structure, but not quite equity. So the loss given default on PIBs would be somewhere between the two. You won't lose everything, but you'll certainly lose something. And it also depends on the credit quality of the company. You know, lower quality credits, usually you'd expect more wipeouts further up the capital structure. But remember, it's usually financial companies who have issued these PIBs. Why do they pay a higher rate of interest than, say, the normal bonds issued by the company? It's because of the higher risk. It's greater loss given default. So that's why the interest payments are high, because it is a higher risk and a greater loss given default than senior bonds, say. So that's the risk. Many PIBs also have calls, an option that allows the issuer to repurchase the bond at certain dates. So if the cost of funding becomes too high, then if interest rates have increased, or if the credit spread of the company widens, let's say that, I don't know, nationwide, their credit quality suddenly looks a bit dodgy and the credit spread widens and the value of their debt falls, well, they have an option to buy back that debt. And so from your point of view, you'll just get your money back, right? You'll stop receiving interest and you just get your capital back if the issuer nationwide calls its debt. So that is a risk, that you get called on the debt, but all that means is you just get your money back and the interest stops paying out. But the juicy bit, and this is the good bit, is the coupon. Just look at these coupons. 6.9%, 12.1, 7.9. Is Nationwide Building Society going to go bust? Maybe, but if it doesn't, you're going to earn this coupon on the PIBs of about 12%. So, would I consider buying this? Yeah, maybe. Let's look at the price of one of these. You'll also see how illiquid it is. Let's use the ISIN code here. Have a look for that. Let me just pull up SharePad. It's probably going to be on there. Here we go. And we'll search for that ISIN. Here it is. Oh, we've got dogs outside. Here we go. So you see how illiquid it is. When you see a price like this, you see how it looks kind of blocky. That tells you that this thing's not trading very often. And you see how it looks kind of bondy. It's not very volatile. It just kind of fluctuates slowly. But that's just the nature of the beast. And it is increasing in price. So one of the things to watch out for maybe would be a PIB price which was falling sharply. If that's the case, then people may be worried about the credit risk. But clearly in this case, for this nationwide PIB, it's not really falling significantly. If it is floating rate debt, which in this case it is, then it's not going to be interest rate sensitive either. So if interest rates increase broadly, it's not going to be sensitive to that. It will be sensitive to the credit spread of Nationwide. So if it looks like Nationwide's going down, then the credit spread would widen and the price of the PIB would fall. So that's the way it works. And you can see they have these kind of bond-like prices of around 100, because they are bond-like in a way, but they are subordinated debt, right? So subordinated debt, bigger loss given default, bigger income, and of course it has this call option embedded in it, so that if the spread does widen a lot, you could get called. But the risk is, of course, that there could be a default as well. The price would probably start falling before that happens, but would you be able to beat the market and pull your money out in time? Maybe not. So really, as with all these things, you've just got to have a feeling for the credit risk that you're taking. If you don't understand it, I'd say don't buy it, because that's always a good motto. If you don't understand the risks, you don't understand the product, then keep away from it, because the chances are there are risks which you don't understand. And if you look at one of the fact sheets for one of these PIBs, for example, if you look at the prospectus, I bet it's chunky and difficult to understand. I wonder if we can find... here we go. I wonder if they mention it here. Yeah, so here we go. This is some of the details about that PIB. Looks like it was acquired from Cheshire, a building society. Maybe that was merged with Nationwide, not sure. But you can see that it's earning 6 months SONIA plus 4.2%. So it's floating rate income that you receive. So it's the 6 months SONIA rate plus a fat spread on top of about 4.2%. That's what you're going to earn. And it's a perpetual instrument, so it pays out forever. It has no maturity date, but it could get called if they need to refinance at a lower rate. For example, if it just looks too expensive to finance, it could get called. But you can see how complex it is. And this won't contain all of the complexity. You'd have to read the entire term sheet for that and the entire prospectus. And there are people who actually do that, and you probably do need to do that in order to understand the risks properly. But, would I buy it? Yeah, I'd think about it. But, it would definitely be part of my fund portfolio. I wouldn't put a lot of money into one of these, because if one of these entities does default and you've got a lot of capital tied up in it, then clearly that would be a problem. So I'd only invest money I could afford to lose. I'd put it as part of my fund portfolio, and certainly not as part of my core. So yeah, and you probably need to diversify. So if you're buying corporate bonds like these, you need to have several issuers in order to diversify. And that way, if one of them does go down, it's not going to have a catastrophic effect on your portfolio. Whereas if you buy gilts, government bonds, the default risk there is very low, almost zero. So there you don't have to worry about diversification, because it's the same issuer and they have perfect credit quality almost. But for corporate bonds, you need diversification, just like you do for stocks. So those are the considerations. Do you understand the risks? Do you think the issuer has a risk of going bust, in which case keep away? Do you think the return you get on it is sufficient for that risk which you're taking? And there is a risk, for some of these entities. Those are the considerations. So I hope that answers your question. I feel as if I should be more thorough because you paid so much for it. But thank you so much. That's incredibly generous. Thank you, Richard. That's the biggest super chat we've ever had. £100. Thank you. There's a question from Ivan Garcia Noves, who is one of our supporters on YouTube. Thank you, Ivan, for the question. Can we believe the data of Q3 about growth, or is it some kind of numbering tricky to finally arrange in the last quarter of the year, last Q4 of the year? I guess you're talking about GDP growth. I believe it, yeah. I think for the US, I really don't think they'd fiddle the numbers. Other countries, we know who I'm talking about, maybe they'd fiddle their numbers. But the United States, I think it's vanishingly unlikely that they'd fiddle their numbers. They could make a mistake, but it would get revised. But would they have a fraudulent GDP number in the US? No. Or in the UK. I mean, that's not going to happen. So I don't really believe that it could be fraudulent. No, I don't believe that at all. So how are we doing for questions? If we don't have many more questions, I think we'll end it there. Thank you all for joining us. Don't forget to like and subscribe, and please do remember that we've got another live stream tomorrow, 6 o'clock. Bank of England will be talking about their monetary policy decision, and we've also got a webinar with Cbonds, and that's in a couple of weeks' time, and you'll find a link to that in the description. And the title of the webinar, let me get it right, is Money Market Funds or Government Bonds, which is best? So monetary policy clearly involved there as well. So sign up for that. I think it'll be entertaining and I hope informative. And a lot of the stuff we've learnt about monetary policy will feed into that, as well as lots of bond stuff, which I find very exciting. Anyway, look, thank you all for joining us. Thank you for spending your evening with us. I hope it was informative. I hope it was entertaining. Teddy had some treats and I didn't choke on my drink. So everyone's a winner.